Welcome back. Despite housing inventory rising to a 4-year high, which is giving homebuyers more options, Fannie Mae is now forecasting that U.S. home sales will decrease to a 29-year low. In other words, the lowest levels since the year of 1995. This also means we'd be missing a whopping 1 million fewer home sales this year compared to the long-run average. In today's video, I'm going to share Fannie Mae's latest housing market forecast for home prices, home sales, mortgage rates, and much, much more. If you guys get any value out of today's video, then please hit the like button. Also, consider subscribing as well. I post frequent housing market updates so you guys can be more informed. And with that said, let's begin today's video. I appreciate you. So according to Fannie Mae, which is, by the way, according to their senior vice president and chief economist, he said, while potential home buyers have noticed the decline in mortgage rates over the last few months, this, by the way, was posted about 2 weeks ago. And ever since then, rates have increased quite a bit, the highest levels since approximately July this year. However, looking at rates today compared to 1 year ago, we still are down greatly though. But it says there, we are equally aware that there has been little relief on the home price side. So in other words, mortgage rates decrease or down compared to 1 year ago, but home prices still increasing, making housing affordability a big issue, particularly for first-time home buyers. So let's take a look at that, looking at rates compared to home prices. According to our good Uncle Fred, the source for rates is Freddie Mac here, looking at monthly rates according to them. As of October so far this year, we're at 6.36%. 1 year ago, we were up to a whopping 7.6%. So rates have decreased by approximately 1.3 percentage points when looking at data from Freddie Mac. Rates have been going down, which improves housing affordability, but here is what is actually causing housing affordability to be at still relatively low levels right now. So the U.S. median sale price, according to NER, or the National Association of Realtors, for the month of September was $404,500. That is a 3% increase compared to 12 months ago. We were at $392,700. So rates decreasing from 1 year ago, but home prices still up by 3%. They also talk about the supply side as well. It says the timing of the long expected pickup in home sale activity, as well as further moderation in home price appreciation. In other words, home prices still increasing, but increasing at a lower rate, will depend in part on the willingness of current homeowners to get rid of, I'm paraphrasing here, their lower mortgage rates by offering their houses for sale. So of course, a lot of people have rates far less than current rates today. I believe the last figure I read was around 75% of people who do have a loan on their houses have a rate below 5%, which is quite a bit lower than today's rates, which is keeping new supply in the market or new listings at relatively low levels, especially compared to pre-pandemic levels. In regards to that, let's take a look at that. According to Realtor.com, for the month of September, looking at new listings. So for the month of September, there was just under 400,000 new listings nationwide. That is an increase from 1 year ago, which is the pink line below, at around 350,000, and also slightly above 2022. But in 2017, 18, 19, 20, and 21, we had more new listings compared to now. Back then, which is kind of this cluster of lines, we had over 450,000 new listings. Now we have approximately 50,000 less at around 400,000. In other words, we have a long ways to go in order to see new listings being at pre-COVID levels, which is kind of keeping housing inventory at bay. We're not seeing giant increases, but this is looking at active listings according to Realtor.com. We are at a 4-year high right now, but we're still way below 2017, which is a blue line, 2018, the orange line, and 2019, which is a red bar. So back then, a red line, we had around 1.2 million to 1.3 million homes for sale. Now we have less than 950,000 at 940,980 to be exact. Can you imagine a scenario in which new listings were basically skyrocketing? Let's just say like new listings were way up here, way above the past several years. Then active listings would also increase greatly, which would put downward pressure on home prices. And right now, we're seeing kind of this reluctance of homeowners selling their houses because of, they don't want to give up their low rates and buy a house with a much higher rate than they have on their current home. And that's keeping new listings at relatively low levels. Fannie Mae also says, of course, continued strong home building activity will also play a significant role as a shortage of national housing stock. In other words, a lack of homes for sale, looking at pre-pandemic levels. Every market's different, of course, right? But the shortage of housing stock remains the primary impediment to housing affordability. If you guys want to see housing become more affordable, you have to earn more money or increase supply, not incentivize buyers to buy houses with these first-time home buyer credits. That's just going to spur home buying demand, making the issue of home prices even worse. If you guys want to see home prices decrease or moderate or housing affordability to improve, we really need to have the supply side increase greatly, which will help housing affordability the most. And where does homes for sale come from? It comes from people listing their houses for sale, but also from home building activity as well. Something interesting about that as well is that they're predicting that housing starts of brand new single family houses will be flat in 2025. So they're basically calling for home buying activity to really slow down next year, which will, of course, limit housing supply of brand new houses. All right, let's change gears slightly here and talk about the forecast for home prices. It says, as measured by Fannie Mae's Home Price Index, or their HPI, home prices increased by 5.9% year over year in Q3 of 2024. So prices rose by 5.9% in Q3 this year compared to Q3 of 2023, which, by the way, is a deceleration compared to the previous quarter's a downward revised rate of 6.3%. So Q2 this year compared to Q2 last year, we're up by 6.3%. Now we're only up by 5.9%. So still up, but the rate is actually slowing down. It also says they are expecting deceleration of home price growth as affordability continues to be stretched out and inventories of houses for sale are rising in some regions. Every market's different, right? Areas like in Texas, Florida, Tennessee, Utah, etc., have more homes for sale right now, I should say at the end of September, compared to September of 2019. Whereas in California, where I live and work as an agent here, we're down by about 23%. Also in the Northeast, they're down by about 50 to 70%. Every market's different, but in general, the areas in which inventory is down compared to 2019 are areas in which home prices are increasing the most. In contrast, areas that have a glut of supply compared to 2019 are areas in which home prices are barely squeaking out a gain or they're decreasing compared to 1 year ago. In regards to their housing outlook for home sales, it says we have modestly upgraded our existing home sale outlook in 2025, largely due to a lower mortgage rate forecast. However, as previously noted, mortgage rates have risen meaningfully, following strong economic data, presenting upside risk to our rate outlook, but also downside risk to our sales projection. In other words, what we're saying here is that a decrease in rates that they're calling for next year is going to cause for home sales to increase. But if mortgage rates remain at relatively high levels, that will put downward pressure on home sales next year. Now, speaking of the forecast for home sales this year and next year, take a look at this. This is a file I put together for you guys, looking at how this compares to years past, going back to 1989. So the forecast this year is calling for 4,060,000 existing home sales. That, by the way, is a 0.7% decrease compared to 2023 and down a whopping 24% from 2018 and 19. Then next year to be at 4.521 million, an increase of 11.4%. Again, probably due to the fact that they're forecasting that mortgage rates will decrease, but we're still down by 15% from pre-COVID levels. In regards to their forecast in 2024, this is more or less unchanged compared to the previous forecast that was posted in September, but much different compared to 2 months ago. 2 months ago, they're projecting that we're going to have 4,129,000 home sales. Now we're just over 4.06 million. These downward revisions, in my opinion, is likely due to the fact that mortgage rates have increased quite a bit over the past month and a half. Also, here's a big kicker. 4.06 million would not only be lower than last year at 4.09 million, but 4.06 million, that'd be the fewest amount of home sales going all the way back until 1995. In other words, a 29-year low, basically a 3-decade low this year potentially. And I'm guessing that we'll see this below 4 million, in my personal opinion, based on my own predictions. Lastly, at 4.06 million, that'd be approximately 1 million fewer compared to the long-run average, because based on my nerdy Excel formula there, the median number of home sales each and every year going back to 1989 is just over 5 million. So we have 1 million fewer home sales this year compared to the long-run average. It's absolutely insane. This does not mean that they're forecasting that home prices will tank or crash though. I'll have more to share regarding that here in a little bit. Something you guys should be aware of though is that looking at sales this year, I'm guessing a little bit less than 4 million sales. Again, the lowest sales since 1995. How does 1995 compare to now? The big difference is population numbers. So the US population and the number of homes for sale nationwide is much more now compared to the 1990s. So for example, according to the US Census Bureau, there was 50 million more people living in the United States in 2020 compared to the year of 2000. So 50 million more people living in the United States over the past 20 years. But they're still calling for home sales to be at the same levels as 1995. The impact to our housing market is this right here. Low level of transactions or sales would put upward pressure on inventory levels. Kind of think analogy I talk about on the channel. Think of a bathtub. The water level in the bathtub is inventory levels. The water going into the bathtub is new listings. The drain of the bathtub is sales. So when we have more sales than new listings or water coming in, the water level goes down. That's what we saw in 2020 and 2021. Right now, we're seeing kind of a lack of home sales. In other words, the drain kind of being plugged up and new supply going to the market or water going to the bathtub at relatively low levels as well, which is kind of keeping the water level or inventory at high levels, but not surging because we're not seeing new supply hitting the market or water coming into the bathtub at a high rate. We're seeing at a low rate right now. Now looking at their forecast in 2025, a big upper revision from 4 million to just over 4.5 million. That would be approximately a 3-year high, but again, around 500,000 fewer compared to the long-run average at 5 million. In my previous video, I talked about Zillow's forecast. They were also predicting around 4.1 million rounded up, which is approximately the same forecast for as Fannie Mae. But again, in my opinion, we're going to be around 3.97 million by the time we hit the end of the year this year. And that's because we have approximately 3% fewer home sales so far this year, which is January through September, compared to the same time frame in 2023. And because rates have increased quite a bit over the past month and a half, I'm guessing we'll probably have fewer home sales in October, November, December, if rates stay above 7%, let's say. And that will cause overall home sales to be below 4 million by the time we hit the end of the year this year. All right, let's have a look at their summary, looking at home sales, housing starts, home prices, and mortgage rates. Let's first talk about home sales. For new single family, look at the big changes here. So in 2023, which is right here, new home sales increased by 3.9% from 2022. Then to basically double that rate to 7%, they're forecasting this year, but then to be flat, again, only up by 0.4% in 2025 compared to 24. Existing home sales, which are defined by single family, condos, and co-ops, in other words, a home sale that's not a brand new house, that decreased by nearly 19% last year compared to the gain of 4% for brand new homes. But the kind of gets reversed here in 2025. They're calling for a big increase up by 11.4% for existing houses in 2025 compared to a gain of only 0.4% for brand new home construction. They're also calling for, again, 4.06 million sales in 2024, which would be a decrease of 0.7%. But again, my forecast is calling for a decrease of existing home sales down by around 3 to 4% from 2023, which would be just under 4 million sales this year. In regards to their HPI and their forecast, looking at Q1 of 2024, which is right there, we had the peak over the past couple of years, up by 6.7% compared to Q1 of 2023. Then they're calling for home prices to increase through Q4 of 2024. But by the time we hit then, we're only up by 3.6%, quite a bit lower than the 6.7% in Q1 this year. Last year, we're up by 5.7%. This year, they're calling for more or less the same at 5.8%, but then it decreased quite a bit, a small gain of 3.6%, which is more or less in line with historical averages. Home prices tend to increase in the range of 3 to 5%, not 6.7%. In regards to mortgage rates, those peaked, according to them, in Q4 last year at 7.3%, but they're calling for rates to decrease every single quarter through Q3 of 2025 and to be paid at around 5.6% for an average 30-year fix in Q3 and Q4 of 2025. So basically ending the year this year at 6.6%, which is basically the average rate they're calling for the entire year, then to decrease quite a bit, down by about 90 basis points to 5.7% in 2025. So please leave me a comment below your thoughts regarding their forecast. My biggest takeaway regarding that is this. I mean, they're basically calling for just over 4 million sales this year. I think that is overly optimistic. Again, I'm calling for less than 4 million, probably around 3.97 million, if I'm not mistaken. It's just a guess, a educated guess based on the level of sales so far this year compared to last year. But also, what really caught my attention is that they're calling for sales to rise by 11.4%. I mean, that's a big increase compared to this year's forecast, which I'm guessing they're calling for that to increase quite a bit due to the fact they're calling for mortgage rates overall to decrease quite a bit as well, or decrease quite a bit in 2025. So much so that by the time we hit Q1 next year, they're calling for mortgage rates to be in the 5s, then to decrease slightly for the remainder of the year. And this is much different compared to what happened in 2023, where mortgage rates increased every single quarter through Q4 of 2023. With that said, please like and subscribe. Hope you guys have an amazing day. I appreciate you guys so much, and we'll see you next video.